All right, so we are going to jump into bonds and long-term liabilities. Most of it's going to be bonds, but I don't know how many lectures it's going to take, but we'll try to break it again into about 15-minute segments to make it a little more bearable. All right, so let's work on talking about bonds at first. So bonds at the core, essentially, a bond is a contract. We talked a lot about this in debt investments chapter, but basically, it's a contract between a company and the general public. The contract does include a promise to pay a stated amount referred to as a principal amount, par value, face amount, maturity amount at a specified maturity date. So they will promise to pay X dollars at this point in the future. That's part of the contract that the company has agreed to make with these public debt holders. It can also include, but does not always include interest. And so contractual interest is going to be stated as a percentage of that face amount or percentage of the par value. That rate is called the stated rate, the coupon rate, the nominal rate, sometimes called the bond rate. Interest most often is paid semi-annually, usually starting 6 months from the issuance. It could be annually, it could be different dates as well, but normally it's going to be semi-annually, and normally it's June 30th and December 31st. Again, it can vary, but most of the time, semi-annual payments, June 30th and December 31st. That's a very typical arrangement. Um, there's a lot of terms that we could go through. Rather than me going through every single one, what I'm going to do is just kind of, for my students, I supply them in the notes. You can read through this stuff on your own. You can pause the video, whatever you want to do to review it. But I'm not going to go through every single one of these. I just don't think that's a great use of time. And then we have these four items as well. Again, these are all terms that on some level you should be familiar with, but I'm just not going to emphasize these things. And so we'll kind of keep moving. So recording the issuance of a bond, we're just going to kind of walk through an example here. So 49er Company issues 850 10-year 9% semi-annual bonds on January 1st, 2025. Each bond has a face amount of $1,000 and the bonds were issued at par. The bonds mature on December 31st, 2034 and pay interest on June 30th and December 31st of each year. Provide the journal entry for the bond issuance. So we're going to walk through this, get used to the language a little bit. So first of all, we know from this information, we know the number of bonds and the face amount, which give us the total face amount of the issuance. And so we have 850 bonds. Each bond has $1,000 par value. And so that means the total issuance was for $850,000. We also know the maturity because basically it's the number of years times the payment frequency. And so in this case, it's a 10-year bond, but there are semi-annual payments, which means there are two payments per year. And so that means the periods for this bond are 20 semi-annual periods, 20 semi-annual periods. Um, as far as the interest payment themselves, we're going to use the bond rate, which is 9%, to calculate the interest payments. But again, because it's semi-annual, that 9% annual rate needs to be divided by 2. And so that division by 2 tells us the semi-annual stated rate or semi-annual bond rate. And so this tells us the percentage that will be used for the interest payments. We apply that percentage to the par value or the face amount, and that gives us the actual interest payment. So 4.5% times the $1,000 par value means that each interest payment is going to be $45. So $45 with each semi-annual interest payment. And so in total, that means with each payment, the payment will be $38,250 for those 850 bonds. So it tells us that the bonds are being issued at par. And so that means that the proceeds that I receive at issuance is equal to the face amount. The issue price and bond yield, which is the effective rate on the bond, those are determined by the market, not by the issuer. So 49er Company, they cannot determine what the market demands in terms of interest from them. They have a contractual rate that they're paying that may or may not be equal to the market rate of interest. And so in this case, though, since it's being issued at par, essentially what that means is the bond is paying the market rate of interest. And so that's kind of the question that we're going to be asking a little bit, but that's sort of what at par means. It means that everything is fair, meaning that the issuer is giving them a fair rate of interest. They're not over or underpaying interest. And so how to record the issuance? Hopefully not too bad. We receive cash. Again, because we're issuing the bond, we are receiving cash. So we receive $850,000, but of course now we have to pay back the par value on the bond of $850,000. We'd already touched this just a little bit, but from the market's perspective, what's going on is they are buying an asset that has probable future economic benefits. And so from the market's perspective, that's all they're doing is they're buying a contract. And what they're going to do is they're going to say, okay, well, what goes into the way that I'm going to price this? Well, it's the amount, timing, and uncertainty around the benefits that the contract is providing. And so there's both the contract, but there's also the riskiness of the bond issuer. And so, certain companies might have differences in their riskiness. And so I might price one bond differently than I would price a different bond because the riskiness might be different. And so, because of the differences in the amount, timing, and uncertainty, it means the pricing on bonds is also going to vary. So, with variation in amount, timing, and uncertainty, there's variation in bond pricing. So now, what's interesting is, again, just to highlight, is the amount and timing of the cash flows that is determined by the bond terms. And so, the company will write a contract, and that's going to determine the amount of the payments and when those payments are made. However, the uncertainty or riskiness of those payments, that is completely determined by the market or the public creditors that the bond issuer is trying to attract. And so, again, there's really two elements, the amount and the three elements, the amount and the timing, which is determined by the contract. And then there's the uncertainty or the riskiness that's determined by the market. And so at its core, the stated rate on the bond is it's the company's compensation for risk. That price, the price of the bond is going to be dependent on if that contractual compensation is equal to the market's true assessment of risk. And so, anytime there's a departure between those two, then the bond will be issued either at a discount or potentially at a premium, whatever it is. And so, the issue here is, again, the way we measure risk for a bond is through interest rates. And so the contractual rate is the company's compensation, and then the market rate of interest, that is the market's assessment of the risk. Again, they may or may not be equal. So in this case, our stated rate was 9% and the bond was issued at par. So what does this tell us about the market's true assessment of the riskiness of the bond? And well, since it was issued at par, it must be the case that the market rate of interest on the bond is also 9%. Now, one thing I want to highlight here is what that means is the market is indifferent between giving 49er company $1,000 or keeping the $1,000. In other words, it's a fair compensation for the risk. So they're really indifferent between giving it to them, giving the $1,000 to 49er company or just keeping their $1,000 and doing something else with it. And so when it's issued at par, it means that the rate that they're giving is exactly equal to the expectation. Therefore, there's sort of this indifference. But what if the market assessed that the riskiness of the bond was more than the company is offering in interest? In other words, basically what it's saying is we're saying 9% is a fair representation of our risk, and the market is saying, no, you're much riskier than that. And so what does that mean? What does that mean? Well, first of all, with more risk, it means that the yield on the bond is going to be more than 9%. So the market rate of interest is going to be more than 9%. And if that's the case, then the bond is going to be issued at a discount because essentially someone's not willing to pay you $1,000 if you're only giving 9% interest. In other words, if I'm saying you should be paying me 10% interest and you only pay me 9% interest on the contract, well, I'm not giving you $1,000. I'll give you something less so that my effective rate is 10%. But that's the difference there. As soon as there's a difference between the contractual rate of interest and the market's assessment of the risk, then it would be issued in this case at a discount because the risk is more than what the contract is offering. So then what if it were the other way around? In other words, what if it was the case where the market's assessment of the riskiness is that actually it's less than what the company is offering in interest. And in that case, it means with less risk that the bond yield would be less than 9%. In other words, in this case, the holder, the issuer, is paying 9%, but the holder is willing to take less than that. Well, that means the demand for the bond is going to go up. And if the demand goes up, that means the price is going to go up as well, which means that it's going to be issued at a premium because they are overcompensating bondholders for the risk. And so a bond can be issued at par, at a discount, or at a premium. And the reason why is because there's a difference, potentially a difference between the contractual risk or the contractual interest rate and the market interest rate. All right, so there are lots of rating agencies out there. Those are the two primary ones is S&P and Moody's. Basically, if there's a higher rating, they're going to be determined to be less risky, which means there's not as much demand for interest from that bond issuer. Again, the issuer cannot determine the riskiness of their bond. The market's going to assess that independently. Since the issuer cannot determine the yield, sometimes bonds could be issued at a premium or at a discount. And so the table below illustrates where that might happen. Again, if a bond is issued at par, it means that the bond rate or the contractual rate is equal to the market rate of the bond yield, which means the purchase or the issue price is going to be right at 100 and the price is going to be equal to the par value. If you have a discount, it's a situation where the bond rate, the contractual rate, is less than what the market demands. Therefore, the bond price is going to be less than 100, which means that the proceeds that they're going to receive, the price, is going to be less than the par value. And then finally, with the premium, means the bond rate is more than the bond yield. It's issued at over 100, which means the price or the proceeds that we receive are going to be more than the par value. Again, this is just that interplay between the bond rate and the bond yield. And just as a practical matter, most companies don't attempt to issue bonds at a premium or a discount. We're going to talk a little bit later in why that might happen from time to time, but just be aware that it's usually not intentional. All right, so rather than getting into this, we are going to stop this here and we will pick this up with the next lecture.